Can interest-only mortgages accelerate your returns in your multifamily real estate investment? In this video, we'll take a look at the traditional structure as well as the interest-only option and see which one comes out on top. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and the author of the real estate book, Sell for More. So let's get right into it and talk about interest-only mortgages. To start things off, let's take a look at how a traditional mortgage payment is structured. And there are two components. There's P&I. P stands for principal, and this is the amount of the payment that's going towards paying down the balance of the mortgage. Then we have I, which stands for interest. This is the interest paid to the lender in exchange for you borrowing their money. So whenever we have a mortgage payment, traditionally speaking, when it's a P&I mortgage payment, part of that payment is going towards paying down the balance, the principal, and then part of it is paying the lender the interest. With interest-only payments, we actually get rid of the principal altogether and we are just paying the interest. We're not chipping away at the balance owing on the mortgage. And why would a lender offer us an interest-only option to begin with? Well, it all comes down to making money. The lender doesn't make any money if we pay down the principal. That's going towards chipping down the balance owing on the mortgage. The lender makes their money when we pay them interest. So it's in the lender's best interest that we pay them the interest, and they don't really care if we pay down the principal. And in large multifamily real estate deals, the cash flow is always tightest when we first acquire the property because we haven't put into place our business plan. We haven't forced the value, raised the rents, done renovations so we can improve the rents we're getting, all of that stuff. So from day one, as soon as we close on the deal, cash flow is often the tightest. And the lender, they actually want our project to succeed. Because we're buying solid assets that cash flow, some lenders offer us interest-only periods to help us out, to help us get a kickstart as we implement our business plan. So let's take a look at a quick example. I've written out a simple example illustrating the difference between a traditional P&I and an interest-only period. Let's say, for example, we've acquired a property and we're placing an $8 million mortgage on it at 5%, amortized over 25 years. Following a traditional principal and interest payment, our annual payment amount is $558,000. And that means by the end of a 5-year hold period, the remaining balance on that mortgage is $7 million. So basically, we've paid down over 5 years $1 million of that mortgage amount. Now, with an interest-only scenario, let's say the lender has offered us 3 years of interest only. That means that for the first 3 years of this mortgage, our payment is only $400,000 as opposed to $558,000. And then after that 3-year interest-only period, our payments then become principal and interest, and we're paying $558,000. This means that our balance at the end of that 5-year hold is $7.66 million. So obviously we're paying down less mortgage, but our cash flow has improved. $158,000 is now being freed up and we can do other things with it. Now the question is that principal amount that's going towards the debt payment, debt service on this side, can that be better utilized somewhere else? We know that when we first acquire a property, especially if it's a value add, we have so many things that we need to do in our business plan, probably some renovations. Vacancy is going to increase as we turn over the tenant profile in some cases, and then we also need to keep ample cash reserves. In most cases, I would argue that the interest-only scenario is better. The reason is mortgage paydown is not an investing strategy. It takes way too long and the returns are dismal. I'm looking for that value add opportunity where I can force that appreciation, really put my money to work and drive the value of the property. By freeing up the additional cash flow, $158,000 a year in this case, I'm able to put that towards renovations or reserves and really improve my cash flow. And this means that I don't have to bring additional capital into that deal. The lender, by offering me this 3-year interest-only period, is actually on my side. They want this deal to succeed, and they're giving me an opportunity to increase my returns and just have better cash flow in the deal. If you're interested in learning more about the deals I'm currently doing, head on over to callseth.com and set up a quick 20-minute phone call with me. And if you like this video, hit the like button, leave a comment, let me know what you think, and until next time, happy investing.